Hi there, I had to look at the stock market today from scratch. Knowing what I know about the record high indexes, the oil shock, the Fed handoff, the AI chip stampede, and the way investors are suddenly acting brave again, I would not treat this like a normal rally. Most people think the question is, should I buy? Should I sell? Should I short? Should I wait? But that is not really the question. The real question is, what the hell just happened to the stock market? And why did fear turn into euphoria this quickly? Today is Monday, April 27th, New York time. Comment what day and date you are watching from because I want to know how fresh this market still feels when this video reaches you. And quickly, if you value this kind of breakdown, support by subscribing and comment John A.G. Best. That tells me you want the real work, not just loud market theater. So in this video, we are going to walk through what actually happened, not the headline version, not the Twitter panic version, the real market mechanics, the squeeze, the rotation, the chip mania, the oil problem, the Fed uncertainty, and most importantly, what I would and would not do if I were looking at this market right now. Because here's the strange part. A few weeks ago, everyone was worried about war, oil, inflation, interest rates, consumer weakness, and recession risk. Then suddenly, the same market that looked nervous started acting like nothing could go wrong. The S&P and Nasdaq pushed into record territory again, helped by tech optimism, Iran negotiation hopes, and a huge semiconductor move. Volume was not some roaring flood either. It was close to recent averages, which tells you this was not simply everyone calmly agreeing the world is fixed. It was more like sellers stepped back while buyers rushed forward. And that matters. Markets do not need perfect news to rally. They only need news that is less awful than people were positioned for. That is the secret hiding in plain sight. If investors are hedged, underweight, nervous, and waiting for disaster, then even a small improvement can force them to buy. So when geopolitical fear eased for a moment, the market did not stroll higher. It jumped. People who were protected had to adjust. Funds that were too defensive had to catch up. Traders who thought they had time suddenly realized the train was already moving. And that creates the kind of buying that feels powerful, but also slightly ridiculous. Now, does that mean the rally is fake? No. This is where I disagree with the easy bearish take. A low-volume rally is not automatically fake. Sometimes it just means there are not enough sellers. If nobody wants to sell, price can rise on less volume than people expect. But it also means the structure can be fragile, because if sellers return, the same market that floated up easily can drop quickly. So this is not a fake rally. It is a thin rally with very emotional fuel. And emotional fuel burns hot. The first fuel source was positioning. Earlier, traders were paying for protection. They were worried about downside. Then, as the market ripped higher, that flipped. Call buying came back. Fear of missing out came back. The same crowd that wanted umbrellas yesterday wanted rockets today. And when options traders lean too far one way, the market becomes easier to shake. The second fuel source was chips. Good grief, chips. The Philadelphia Semiconductor Index hit a record high and stretched a winning streak to about 18 sessions, while the index was up a huge amount for the year. That is not normal market behavior. That is a sector being treated like it is the only door into the future. And yes, AI needs chips. Data centers need chips. Cloud companies need chips. The whole AI arms race needs chips. But a great story and a great entry are not the same thing. Now say that again, please, because Winston would approve if he were here. A great story and a great entry are not the same thing. When investors believe a sector is obvious, they usually start paying less attention to price. And that is how good ideas become dangerous trades. I am not saying AI is over. I am not saying semiconductors are dead. I am saying the most obvious winner can still punish late buyers. That is why I would not chase chips after a vertical move. If you bought weakness, lovely. If you missed it, that does not mean you now need to throw yourself into the most crowded part of the market just to feel included. You have to learn to live with what you missed. The third fuel source was earnings, and this is the bullish argument, so let us be fair. Based on recently published earnings numbers, more than a quarter of S&P companies had reported, and the percentage beating earnings estimates was running above normal historical averages. Revenue surprises were also better than usual. That is not bearish. That is real support. It explains why the market did not collapse the moment oil rose or the moment Fed uncertainty appeared. But here is the problem. Good earnings do not automatically mean good prices. A company can report strong numbers and still be a bad entry if expectations are already sky high. A stock can be wonderful and still be dangerous if everyone already bought it. This is where new investors get trapped. They confuse quality with timing. And timing matters when the market is euphoric. Now, the fourth issue is oil. This is the one stock traders want to ignore because oil is boring until it ruins everything. Oil jumped again as US and Iran talks stalled, with limited shipments through the Strait of Hormuz keeping supply tight. Brent moved into triple digits, and West Texas crude was sitting in the high 90s. That is not some cute little commodity headline. That is a tax on transportation, food, airlines, chemicals, trucking, and the consumer. And the consumer is already irritated. Consumer sentiment fell to a record low in April, while short-term inflation expectations jumped sharply. Gasoline and diesel costs were a major part of that pain because people do not experience inflation through a spreadsheet. They experience it at the pump, at the grocery store, and when the delivery fee looks stupid. That is why the stagflation discussion is not just academic nonsense. Stagflation basically means prices stay annoying while growth loses momentum. Not enough growth to feel good. Not enough price relief to relax. It is a rotten combination. And no, one oil spike does not automatically create a recession. That would be too simple. But if oil stays high long enough, it can change inflation expectations, corporate margins, and Fed behavior. Which brings us to the Fed. The market is dealing with a leadership transition at the central bank. Recent updates show the confirmation path for Kevin Warsh opened up after a key senator said he would allow the process to move forward, with Powell's chair term ending in May. That is not a small footnote. Markets care about the referee. They care about independence. They care about whether policy will stay predictable or suddenly become experimental. Now, I am not going to pretend one person controls the entire economy. That is silly. But a Fed handoff during an oil shock, an inflation bounce, and a stock market melt-up is not exactly a calm little administrative event. If the new Fed sounds too easy, bond markets can get nervous. If the new Fed sounds too tough, growth stocks can get nervous. If the new Fed sounds political, everyone gets nervous. So again, the market can still go higher, but the risk is getting thicker. Now, the next big checkpoint is the earnings calendar itself. Several mega-cap technology companies are reporting in the same window as the Fed meeting, and that matters because the market is not only listening for profits, it is listening for spending plans. If the biggest cloud and platform companies say they are still increasing AI infrastructure budgets, then money may keep chasing the companies that feed that build-out. If they sound careful, the market may suddenly remember that AI spending also has to turn into cash flow someday. That is the quiet test hiding underneath the loud headlines. And this is where I want to push back on the simple story that says, chips are overheated, therefore the whole market must crash. No, that is too neat. Markets usually do not collapse just because one leadership group is stretched. Sometimes leadership rotates. Money leaves the crowded winner and goes into the next group that has earnings, policy support, or a cleaner setup. That is why the better question is not, will chips fall? The better question is, if chips cool down, where does the money go? Because that answer can make you money. Maybe it goes to software, maybe it goes to power, maybe it goes to grid names, maybe it goes to cybersecurity, maybe it goes to companies tied to data centers but not already priced like they discovered electricity yesterday. And maybe, if oil refuses to calm down, some money rotates back into energy too. I know that is not as glamorous as AI, but markets do not care what sounds glamorous. They care what earns, what reprices, and what institutions need to own next. The danger is buying the thing everyone needed yesterday. The opportunity is preparing for the thing they may need tomorrow. Now, what would I actually do? That is the setup I would respect, not fear, respect. Because the market does not punish you for being cautious. It punishes you for being careless right after everyone around you starts feeling brilliant again. That is usually when discipline stops feeling useful, which is exactly when it becomes most valuable. So breathe before pressing that buy button. Rule number 1. I would not chase the indexes at highs just because I feel left behind. That is how people turn a good market into a bad personal decision. The S&P can be strong, the Nasdaq can be strong, and your entry can still be terrible. Rule number 2. I would keep a list ready before the pullback happens, not after. After the pullback, you will be emotional. You will be watching red candles. You will be reading scary posts. You will convince yourself that the end has arrived. So you need the list now. What goes on the list? First, quality software that did not participate like chips did. Not every software stock. Please do not buy a basket of nonsense and call it a strategy. I mean profitable, durable companies where the story was ignored because everyone was staring at semiconductors. Second, cybersecurity. In a world where AI increases both productivity and threats, security spending does not disappear. It may slow, it may rotate, but it does not vanish. Third, data center infrastructure and power. This is the part people are finally waking up to. The Energy Agency's latest long-term outlook says data center load is becoming a dominant driver of U.S. electricity growth, and generating capacity may need a major expansion over time. Translation: AI is not just a chip trade, it is an electricity trade. It is a grid trade. It is a cooling trade. It is a real estate trade. That is why I would watch utilities, power generation, equipment providers, and selected data center names. Not blindly, not all at once. But I would watch them for pullbacks because the next rotation may not be from weak stocks to strong stocks. It may be from obvious AI to necessary AI infrastructure, and that is a different conversation. Fourth, I would watch trading platforms and crypto-linked names, but only as risk appetite trades. If Bitcoin sentiment stays firm, some of those names can move quickly, but do not confuse a fast-moving trade with a safe investment. They are not the same animal. Fifth, I would watch defensive growth names with cash flow, buybacks, and less dependence on chip hype. Something like streaming can sometimes behave better when investors want growth but do not want to live inside the most crowded AI trade. But even there, price matters. Everything has a price. Now, if you are successful, share your success story in the comments so others can stay motivated. And tell me this as well. Are you waiting for a pullback or are you already buying this rally? Because this is where discipline matters. Most people do the exact opposite of what they should do. They are scared when stocks are down, then confident after the move already happened. They want certainty, but certainty is expensive. By the time you feel safe, the discount is usually gone. So your job is not to feel safe. Your job is to be prepared. If chips pull back, have your levels. If software wakes up, know which names are actually worth owning. If oil keeps rising, understand that it can pressure margins and consumer spending. If the Fed transition gets messy, expect volatility. If earnings stay strong, respect the upside. You do not need one dramatic view, you need a flexible plan. And please, do not turn this into an all-or-nothing movie. You do not need to be 100% in cash. You do not need to be 100% invested. You do not need to short every rally or buy every dip. You can trim crowded winners, you can hold core positions, you can keep cash for better entries, you can wait. Waiting is an action, it just does not give you dopamine. This market is excited but fragile. It is supported by earnings but threatened by oil. It is powered by AI but crowded in chips. It wants a friendly Fed, but inflation is tapping the glass again. It is not simple. And when markets are not simple, the people who pretend everything is obvious are usually selling confidence, not wisdom. So do the boring work. Track your watch list. Know your entries. Do not chase because somebody else got rich before you. Do not panic because oil had a big day. Do not marry a stock because it made you money once. Markets reward flexibility and punish ego. And if this helped you see the market more clearly, subscribe. Short and simple. The next few weeks could decide whether this rally becomes a launch pad or a very expensive trap. And just to be clear, this is for education and market discussion only. I am not your financial advisor, and I do not know your income, your risk tolerance, your time horizon, or your obligations. Use this as research fuel, not as a command. Your decisions need to fit your life, not my voice on a screen.